Hello and welcome to another episode of Bidishanomics. I am Sabika Syed and with us Dr. Bidisha Bhattacharya, our consulting editor for economics, who takes your questions, dear members, on economy, India's position, how global affairs are impacting us. The first question is by Anubhav Saxena. He's asking, in terms of employment figures, which sector in India provides largest employment and which sector is declining in terms of employment generated, and what is the government of India doing to support those sectors?
A very important question, I must say, because it tends to confuse a lot of people. You know
Right.
exactly what's happening. The last time I believe that we've discussed sectors was after the 1991 reforms that way, because services boomed so much. So now let's start with the first part of the question, that which sector employs the most Indians. Now the answer is agriculture. And the data, when you look at the data, the other sectors are not even close to it as per the latest government data, the PLFS Periodic Labor Force Survey that was released in this March of 2026 by the Ministry of Statistics. Agriculture employs approximately 43% of India's workforce. Now, that's kind of more than 4 in 10 Indians, if we sort of do a count. Now the good news here is this percentage has been declining. It in 2024 it was 44.8%.
Okay.
Now usually when a number falls or declines, I say that it's bad news, but in this case it's good news. So here what exactly is happening, because it's important to understand for all economists across the world, because agriculture as an economy for every country is very different. In case of India, agriculture sector is kind of overcrowded given what it produces or how much it produces. I'll give you a couple of data points here to understand or sort of put things in perspective. So now agriculture kind of contributes 16 to 18% of the total output that is produced in the economy, which is the GDP, right? But it employs 43% of the workforce. So that means that every farm or every kind of factory that is associated with agricultural production in some way has too many hands compared to relative to how much it produces. Now here this kind of signals at an issue that in some way or the other we have hinted at or discussed, in fact in the previous episode
Right.
itself, where we've spoken about the different kinds of unemployment. This particularly in economics we signal as disguised unemployment or underemployment. Now coming to whether is this a well-known pattern in economic history, has this happened before? Absolutely. In 1950s, a Nobel Prize winning economist, Arthur Lewis, this is something we've been taught in some way or the other in bits and pieces in textbooks and Econ 101. He had signaled or he had spoken about something called this concept of dual economy that exists in poorer economies basically, or underdeveloped economies, where there is this one particular sector which is a traditional sector that was hinted at in the model. Say for instance in our case the agriculture sector, which sort of absorbs or employs unnecessarily higher number of individuals than needed. And then there's a modern sector that can be industry and services, that over time is has to take on the baton or the responsibility to absorb these surplus workers. So now India is kind of going through this process. We are a growing and an emerging economy, and it is going through the process where surplus workers are absorbed kind of from agriculture or transitioning from agriculture into manufacturing industry. Services kind of take some time, but this transition is kind of happening.
Okay.
Now this is not the interesting part, I would say, of the entire story, or the two to three questions that you've asked, Anubhav. Coming to, because this is something that over time, from a low productive economy to a high productive economy, or this transition that takes place, that is inevitable. That has happened with multiple economies in the past. Coming to the second part of your question, which asks which sector is declining. Now, for years and especially for the last 2 decades, economists across, have complained about the fact that manufacturing has not really grown despite the amount of investment and dialogues that India has had. So here I would like to state certain data points. Manufacturing, when it comes to employment, it contributes approximately roughly between 11 to 14%. However, manufacturing, or the output that the manufacturing sector has been producing, has been increasing over time. Now, that unambiguously hints at a factor that probably most of these output require capital intensity or capital intensive production than labor intensive production, which is why there isn't being a proportionate increase in the number of workers who are hired in the manufacturing sector. Now, coming to why is this something that we should worry about, or probably for the last 1 decade or 1.5 decade, you might have heard about this term called the jobless growth.
Right.
That is what was kind of hurting or ailing the manufacturing sector. Exactly what I spoke about. Output is growing, but there's not proportionate increase in the number of workers or number of employees that are being hired. Here are a couple of PLFS numbers that might encourage you today. Now, given the data as per PLFS 2025, manufacturing share to employment has actually grown from 11.6% to 12.1%. But here, another data point emerges, which is a bit scaring. Within manufacturing sector, there's a big section, or the most, let's call it the single biggest shock absorber, whose contribution has been dropping, and the drop has been very little, but this is something that needs to be looked at right away. That is construction. Now, construction has dropped from 12.3% to 12%. Why is this something to worry about, or the government needs to immediately look into? Whenever any worker in agricultural sector wishes to move to another or a manufacturing sector, the first section they look at is construction.
Right.
Because given the labor productivity, or it doesn't require a lot of degrees to get hired, and also there is demand for it because there's constantly there are highways that are being built or other forms of infrastructure. So this is where the government seriously needs to look into, because the contribution of construction to employment is kind of falling.
Okay.
Here comes the last part of your question. So what is the government actually doing about all of this? Government is doing something very interesting, which has, first, let's talk about the results that have come up. The first tool that the government has been using, which is the production linked incentive schemes. Now that has given or that gives companies kind of a cash incentive ranging from 4 to 6%, given on the output that you produce above the baseline, above what you are supposed to produce. And on the basis of that, you're giving cash incentive. This has actually reaped results across 14 sectors, and to be specific, electronics, pharmaceuticals, and also the automobile sector has shown a lot of good results. And the government says that the scheme has actually helped generate 14 lakh, or approximately 1.4 million direct as well as indirect jobs, alongside generating approximately 2 lakh crore rupees in actual investment.
Okay.
Looking at the result that production linked incentive has given, in 2025 itself, October 2025, the government came up with the employment linked incentive scheme, which kind of give certain incentives to the employers for directly hiring. To be specific, up to 3,000 rupees a month for 2 years. Every new employee they keep on for at least 6 months.
Okay.
So this kind of this is an incentive. Specifically, the goal is to create an additional 3.5 crore jobs, but the specific focus will be on freshers, or people who are just entering into the job market. So to give you an all-in-all response, definitely agriculture remains to be the sector that employs the largest amount of workforce in this country. However, there is a transition that has been happening. I've just stated the numbers, I've just told you the data, and the results that PLI schemes have shown, that needs to be fast-paced even further. But specifically, I don't know why there's not been too much of discussions around it. And thanks to your question that we could talk about it specifically, that construction is an area that needs to be looked into, because that stands to be the single biggest shock absorber when it comes to farmers or people in the agricultural sector transitioning to the manufacturing sector.
Okay. Bidisha, the next question is by Navina. She's asking, countries such as India, Pakistan, Bangladesh, Libya, and Nigeria often rank among the world's cheapest places to live, while China does not rank equally low despite its vast manufacturing base and significant agricultural production. Intuitively, a large country with strong domestic production and agriculture should have lower prices and better affordability. Why then are several smaller or less industrialized countries even cheaper, and what economic factors explain this apparent paradox?
This is an excellent question, Navina, and because it challenges an assumption that most of us tend to make, given the data that is available to us. Now, the puzzle, very rightly that you stated, countries like India, Pakistan, Bangladesh, Nigeria, Libya, I'll get to a little later because the problem is different there. They kind of show up as the world's cheapest places to live. However, China doesn't. And there's a Numbio's 2026 cost of living index where New York stands at 100, India stands at 19, Pakistan keeps fluctuating between 18 to 20, and Nigeria, Libya is somewhere between 17 and 18, Nigeria is also somewhere around that. China, on the other hand, there scores around 30. That's roughly 60% more expensive than India and Pakistan, to be specific. Now, your question, why? Firstly, it's important to understand what, given the data that is available out there, that China has done phenomenally when it comes to manufacturing and huge manufacturing output. It also shows up well in huge agricultural production as well. Now, however, the question that you asked, that why are smaller, less industrialized countries more cheaper? Now, it's important to understand cost of living is not about how much a country produces in total. Cost of living is how much a country produces per person.
Right.
It's important to understand this difference. So here specifically, how much a country cost of living, now that we've understood, it's how much a country produces in person, and whether or not that translates into wages or not, whether or not that has a wage pull effect or not. I'll explain why. So there have been instances, or there are instances, or countries where a country produces huge amount of food, crops, doing really well in the manufacturing sector and everything, but the country has low income per person. Why? Because that production is thinly distributed across huge millions and millions of individuals.
Right.
The population is very high, or probably it's not trickling into other sectors for that matter. So there is a possibility, and there are economies and countries of that kind. So let me first give you the scale of the gap when it comes to, because we just spoke about wages, and that is also an angle that needs to be understood in this picture. So China's GDP per person has been roughly 5 to 6 times higher than that of India. The wage data that is available there shows that, a very recent comparison, that in manufacturing wages, just for an Indian factory, India's, it's approximately 3% of the US wage levels. However, for China, it is actually 20% of US wage levels.
Okay.
So there's a big difference into how much an Indian factory worker and a Chinese factory worker earns in the first place. I won't even move to the other sectors. Now here coming, it's important to understand this cost of living paradox and where is it hailing from. Now there is a very, very interesting concept called the Balassa-Samuelson effect. Now this had happened back in 1960s. Two economists separately had highlighted this issue, Bella Balassa and the Nobel laureate Paul Samuelson. So they had specifically spoken about this model where they had said that an economy can be segregated into two sectors. There are tradable sectors and there are non-tradable sectors. Tradable sectors are the ones which can scale and compete at a global level with the other economies. Manufacturing sector, for instance, what China has done with the manufacturing sector. Then comes non-tradable sectors where, hair salons, haircuts, restaurant meals, local transport, basically the ones where transactions majorly happen at a local level, domestically. Right. Now, what happens is, for an economy, when they scale or do really well in a tradable sector, Obviously, I mean, it's a no-brainer that the wages will increase in that
Yeah.
sector. Now, the workers who are in the non-tradable sector, they won't remain silent. They will fight for, higher wages as well at the same time, because now the wages in the tradable sector has increased, or they will skill themselves and educate themselves and move to that sector in order to not let that transition happen, so that domestically everything is provided for, the economy overall increases its wages. That's exactly what happened with China. Now, coming to India and Pakistan or Bangladesh, we have not been, let's take India's example, we have not been able to do this because our informal sector is very high, contractual jobs are very high, there is no data for it, and at the same time, the minute you have an economy where the informal sector is so big, we all know corruption exists there, people work for much lower wages, then automatically, for local transport or for just a haircut or anything of that sort, they can't really demand higher wages. So economy wide, the wage pull effect is very low in these cases, even for the case of Nigeria. Now, coming to Libya's case, I said I would be going to Libya later on. Now, Libya's story is slightly different. Libya is oil rich. However, most of those food, fuel, and other products or domestic products in Libya are heavily subsidized by the government. At the same time, because of different unrests, political unrests, different kinds of unrest, the economy has been very destabilized. And at the same time, because it's an oil rich kind of a country, and hence extraction of oil is more of a capital intensive process and less of a labor. You don't need too many labor to be able to do that extraction and export to the rest of the world. Hence, this is a different problem that Libya experiences. However, for India, Pakistan, and Bangladesh, it has been that primary reason as to why we have not been able to probably, or we show up as, relatively much cheaper nations compared to a China.
Right. Now, Bidisha, Narendra Arya's question takes us in a different direction. It's also making us look into how climate is affecting economies and finances and politics. He's asking, we were expecting less rainfall due to the El Nino effect this monsoon. Now, June and July months are over. Please tell what the actual status of monsoon so far is and how the agriculture sector is going to perform in these circumstances.
Now, this is a question I've been asking myself as well, because I was one of those who was very worried about what's going to happen, given, the ethanol blending into the picture, and ethanol being highly dependent on a crop that is also kind of looked into when domestic demand is kind of captured in or factored in, which is rice.
Yeah.
Rice, and of course sugarcane, maize, and other crops, but rice to be specific. So El Nino, first let's understand what exactly El Nino is. El Nino is when a part of the Pacific Ocean, which is near South America, warms up, and that historically, I mean, history states that affects the India's monsoons in some way or the other, and usually it affects it adversely. Now, the IMD, India Meteorological Department, had published a report around May, which had stated that this year we would be experiencing quote unquote poor monsoons, right? So what exactly happened? Now we have to look at two specific months to understand what exactly has been going on. If we look at June, June was bad. June was very bad. India got about 40% less rain than it normally does in a month. If I have to put this in perspective, since 1901, we have been recording sort of India weather records or India weather data. So in the last 125 years, probably this is one of the 5 driest Junes that we have experienced. Now, if you were looking at July, after July arrived, it was kind of a roller coaster. So the first 2 weeks, 1.5 weeks of July, there was heavy rain. Then there was a little dip, and then again, kind of towards the end of July, we are seeing what's exactly happening. Primarily, the eastern regions, northeastern regions, or the southern regions have kind of experienced much heavier rainfall compared to the central or the northern regions. So it's important to note this, because this is not happening, in a similar fashion for every single state, and that impact impacts as well. I mean, it's not like a country thing, but more of a regional thing.
Right.
Here, I would also like to mention specifically the states that have been badly hit in July due to the heavy downpours, which is Maharashtra, Madhya Pradesh, Gujarat, and Rajasthan. Now, where does that leave us? For overall the June and July period combined, we are still short of rain. About from 40% it has come down to 15%, but we are still short of the threshold. And the direction has been very clear, because now the weather forecasters, the scientists have come up and they've said until the first half of August we can expect good amount of rain. In fact, heavy rain can also be expected. So why am I specifically focusing about till the first half of August? Because right now what we are experiencing, or the season that we are experiencing, is the Kharif season. Now, why are we talking about Kharif season? Because this is the season where one of the most important crops, not only from a domestic perspective, but also from an export, from a trade perspective, is sown, which is rice.
Right.
And rice requires a lot of water. Now, what had happened, because of this confusion, a lot of farmers actually sowed less land, covered less land compared to what they did last year, when they thought of the amount of production that they would do this year, because they were confused, and of course that would lead to a lot of crop wastage. Rice, of course, has not borne the brunt yet as much, because it is subsidized, and then from the MSP angle as
Right.
well. However, when it comes to pulses, oil seeds, your dals, oil seeds, and then cotton as well, their sort of the area that has been cultivated is actually 4 to 6% lower
Okay.
than the last year. So this is something to worry about, because it's important to understand, that for a crop it does not matter what is the total rainfall in the season. For a crop, all it matters is whether the rainfall happened at the right time, when the farmer was sowing the seed in the
And
land.
in the right amount.
Exactly. So that is what matters more than anything else. So now, with the forecasts in picture, where they're saying, till the first half of August we can expect good amount of rainfall, then farmers can evaluate accordingly. Now, at the same time, it's important to mention that there are certain insurance schemes that are put in place. There's an insurance scheme that protects farmers for exactly this kind of up and down monsoon, because El Nino is not happening for the first time. We've experienced this earlier as well. So the government is prepared in some way or the other. At the same time, there are small farm ponds and also kind of water storage projects, given our groundwater depletion as well, that holds a decent
Right.
amount of water that could help with the production, in case, God forbids, that the rain is exceedingly, or the rainfall is exceedingly lesser compared to the last year. So yeah, that would be my
Yeah.
response.
Now, Bidisha, the last question is by Sahil Bhatia. He's asking, when do you see the AI tech bubble bursting? Many have said that early 2027 is when it might start to pop, as more investors start demanding a return on their investments in AI. What are the thoughts of economists on this bubble and the implications it will have on the globe?
Thank you for asking this question, and specifically talking about the early 2027. I'll explain why. But first, let me just clarify one thing. No economist in this world can tell you when a bubble will burst. However, an economist, given the data, can tell you why the conversation has become so crucial at this
Right.
point. Why are people talking about this AI bubble and AI bubble burst? In order to understand that, let's first look at the data, right? So, Goldman Sachs published a report where they estimated five biggest, what they are calling as hyperscalers. There's Amazon, there's Meta, there's Alphabet, there's Oracle, and then there's Microsoft as well. So now they have poured in together roughly $368 billion into this AI, picture for 2025, just for the year 2025 itself. However, the revenue that this has been generating, let's take for instance just OpenAI as an example. Now, OpenAI is expected or estimated, given subjected to the proviso, and that everything else is constant, to generate approximately 12 to 13 billion dollars in revenue. Now 368 billion dollars spending and generating only 12 to
Yeah.
13 or 12 to 16 billion dollars in revenue. Now this gap kind of looks very scary, and the data has been given not just by Goldman Sachs, there are multiple other reports as well. So now there's something that has been rattling analysts lately a lot, which is the concept of circular financing.
Okay.
This is a tendency that everybody is noticing in this AI market particularly. Let's take for instance Nvidia. Now Nvidia has invested in billions in the OpenAI. Okay, so now what OpenAI does, OpenAI has taken that money and will be using the money to build cloud computing capacity and also chips, buy chips. Now they'll purchase those chips from Nvidia, who is producing those chips.
Right.
And now this has been going on, and Nvidia is not just the only company that has been doing this. Google has also started to do this with Anthropic. Google has made a very similar move where it has been guaranteeing lease payments, for Anthropic's data centers to be specific, and that has actually helped Anthropic team to kind of raise $35 billion approximately. That's the data. Now the concern here is not that either of them is dishonest. The concern is the minute any of them stumbles, the risks will not be, because given the fact that AI is now integrated into every single thing that we can think of, now the biggest risk here is not that any of them can be corrupt or the data can be false. The biggest risk is if either of them, any of them stumbles, then the risk will not be contained within that circle. It will ripple to every single sector in the economy that you can think of. Because AI is integrating, and the riskier or the scarier bit is AI is integrating very fast at this point. In fact, there has been a particular report, and this has gotten so risky that the Bank of International Settlements, which is considered as a central bank of all the world's central banks, have actually highlighted in their latest report that AI financing and circular deals is one of the major threats to global financial stability in 2026, alongside rising sovereign debt and inflation. Right? In fact, in early July 2026, there's an internal report or an interim report by the US Treasury Department that got leaked, which has been heavily looking at or studying the dot-com bubble burst back in 1999 and 2000s, and kind of comparing the situation. So this is something that people are scared of, given that so much money is into the picture. And in fact, last episode in Bidishanomics, we had discussed about SK Hynix and Samsung, and how South Korea is emerging as, there's a huge section of its exports which is all about this HBM chips, which has been actually responsible for ChatGPT and what it is today, the high bandwidth memory chips. So now kind of companies are scared because the money is already in. We don't know how the output is going to pan out, basically, how things are going to pan out. So now the fact that AI is so deeply woven into the broader economy, with utilities, with credit markets, with cloud providers, that just one single mistake here and there that could trigger any kind of, I wouldn't say bubble burst. Even back then, that episode when we were talking about SK Hynix, I specifically highlighted we won't expect a bubble burst, and I'll tell you why. In the dot-com bubble, a lot of investments were made just on the basis of hope. That things are just going to happen. Now there are actual results that companies are seeing, and on the basis of the forecasting of those results, this money has been invested. So a bubble burst is something that I don't see happening, but something very closer to it might be possible given the numbers that we are seeing, specifically. There's actually one particular economic idea here that I would like to talk about, which is the Minsky effect. Now, this was actually named after the economist Hyman Minsky. It was highlighted much later in 1998, where it sort of spoke about how periods of very solid credit fueled growth kind of quietly builds up a hint of fragility in the picture as well. And even before we realize it, it kind of hits the economy.
Right.
So that is something what kind of, this is kind of a textbook example of what's happening right now. Now, not just the Goldman Sachs report or the US Treasury, the internal report that we've spoken about. Rockefeller International's chairman Ruchir Sharma is actually saying that AI checks every box when it comes to hinting at a bubble burst, and he has specifically mentioned four such indicators, one being over investment, then over valuation, then over ownership, and over leverage. And also within Goldman Sachs itself, there are kind of two teams now. There's a team that is saying that for sure there will be a bubble burst. There's a team that is saying that no, the market can get hot, like from very hot to hot, because we can expect more competitors to come into the picture. But right now, given the money flowing and the investments that are coming in and more informed investments, we won't expect a bubble burst.
Right.
Now, why is the early 2027 period being highlighted so much? Specifically, there are a couple of real data that's available out there. Anthropic and possibly even OpenAI, they are expected to test public markets with IPOs in the late 2026, which will be the first real market judgment. That and if it fails there, then it gets a bit tricky. Then comes separately, some analysts also estimate OpenAI's cash reserves to run out by the mid of 2027 if another big investment into OpenAI doesn't take place. So 2027 is not really a random guess. It seems to happen. I mean, it seems to turn out to be so that a lot of these things are kind of falling in the same place at exactly around that time. And if any one of them kind of is triggered towards or pushed towards even a hint of failure, that might signal or push the economy or the world economy as a whole towards an AI bubble burst, and all of us will suffer because of it. Every single country will suffer because of it. So,
So, Bidisha, I think safe to say that with every tech innovation and then disruption, economy and markets have a facelift. And our eyes are on this, and Bidisha will have her eyes on this. We'll be back again next week with another episode of Bidishanomics.